Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Steve Wyett, chief investment strategist at Nasdaq listed BOKF Financial, to discuss his 2021 outlook. Steve, it's great to have you with us. Welcome to Trade Talks.
Jill, thank you. Really appreciate the opportunity to be here today.
And we're glad to have you. And one of the key themes for 2021 will be the inflation watch. What do you expect out of the Fed as it relates to interest rates and policy?
Yes, Jill, well, the FOMC's meeting today and tomorrow. I'm sure it's going to be a topic of discussion. And I've got to say at its base, I appreciate the optimism and the concern about inflation, because if we're going to get inflation from this point in our economy, a lot of really good things have to happen. We'd have to see the economy be fully reopened, unemployment falling, those areas of the economy that have been lagging, getting re-engaged in the economy. So I can understand at the base of the concern about inflation. Money supply last year was up, what, 20% plus? We've got deficit spending. We've got negative real interest rates. For those of us that went to school in the late 70s, cut our teeth in the markets in the early 80s, this is a perfect environment where we would expect inflation to rear its head. I've got to say, though, we're going to push back on that a little bit. I think the Fed is going to push back on that a little bit, fully understanding that as we lap some of the inflation numbers that occurred during the worst of the pandemic, late February, March, April, we're probably going to get some year-over-year numbers on inflation, CPI, PPI, the PCE, that look like inflation is coming. But I'd listen to Fed Chair Powell as he talks about the fact that reflation is not inflation. One-time price increases, you don't extrapolate that out to the future. So I think the other thing that the Fed has done that I think gives them some room is they've changed their policy around inflation, where that 2% inflation level is no longer a cap, but they're managing to an average of 2% inflation. And so just taking them at face value, we could see PCE, core PCE, the Fed's preferred measure, be above 2% for some period of time before we think the Fed would, to paraphrase Fed Chair Powell, think about raising rates. So we think that it's going to be a while. If we would see sustained inflation above 2%, that's a risk factor to our outlook, just based on the shift in the stance of what we would expect from the Fed. But in the interim, a lot of good things would have to happen for that to occur.
Steve, do you think there's going to be a need for continued stimulus?
The interesting word in that question that as you pose that, Jill, is need. We're going to get more fiscal stimulus in addition to the CARES Act, the $900 billion that we got in December. President Biden and his administration are already pushing for an additional $1.9 trillion. Whether we get that number or something less than that, there's additional fiscal stimulus coming. And not unlike many other questions around these types of topics, the answer to the need is yes and no. There are parts of the economy that absolutely need additional stimulus, that need help. Restaurants, hotels, travel, leisure, casinos, those parts of the economy continue to really struggle. And there's big chunks of the employment that are involved in those areas of the economy too. At the same point, there's large parts of the economy that have been able to recover, use technology like we're on today to achieve a work from home balance where we're able to do our jobs and continue to drive economic growth. And in those areas, you look at it and say, we don't really need additional stimulus. But in the absence of being able to really have a finely targeted approach, I think we'll err on the side of too much stimulus. We got a new Treasury Secretary yesterday, confirmed yesterday, right? Former Fed Chair Janet Yellen. She's been clear that she's a fan of going big from a fiscal stimulus standpoint. So I think everything's lining up that we're going to get additional fiscal stimulus, which I think will be additive to our outlook from an economic growth in the short run. Not unlike monetary policy, though, Jill. If we want to think about the longer term impacts of what we're doing today, then the eventual outcome becomes a little bit more cloudy.
Right. And that's a great point. Do you think the economy can get back on track in 2021? What are you benchmarking the data against? 2019, for example, we talk about the return to normal, comping 2021 over 2020. It's apples to oranges. So how do you benchmark it?
Yeah, and I would have to say this, look, our outlook for GDP growth for 2021 on a real basis is in the 4 to 6% area. And I think that if we're anticipating a change to that going forward, it may be to raise that rather than lower that. But not unlike the inflation question, Jill, a rebound in economic activity is not expansion. So that's kind of where I think you're getting to your point about the benchmark. We've got to work hard and have growth above trend for some period of time just to get to where we would have been if we hadn't gone through the pandemic, right? And so I'm not exactly sure when that's going to happen, but we are anticipating above trend growth for 2021 and at least the first half of 2022. I would hope that gets us back to trend. And from a benchmarking standpoint, then we're in an economy that's in an expansion mode and able to move forward from that point.
And Steve, finally, your thoughts on earnings. Results are going to have to justify some of the valuations at this point.
Yeah, no doubt. It's early in the fourth quarter earnings season, although this week and next week are the two biggest weeks. There's something like 70% of the companies that have been exceeding both earnings and revenue estimates, misses and beats on both sides. But as I think we'll end up somewhere around $125 to $130 per share for 2020. Our early call for 2021, 165 to 175. So a pretty big jump as we get into 2021. I would caution, we're not looking for equities to have a similar type of increase in value. A lot of that growth that we're expecting for 2021 in earnings was pulled forward into 2020 for everything that happened in 2020. And there was a lot. It was a great year in the capital markets, pretty much across every asset class. So it's a little harder to think about what that means from a capital market standpoint, but just in general. We remain in a position for our accounts where we're making the asset allocation call. We're overweight equities, we're underweight fixed income. We're not looking for equities to have similar performance as last year, but still in a position where they'll outperform fixed income and cash as we move through this year.
Steve, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.